The global financial system is once again turning its attention to the United States as political uncertainty raises serious questions about the future strength of the dollar. Donald Trump's influence on economic policy has revived debates about trade, fiscal discipline, and the long-term credibility of America's currency leadership. Investors across the world are carefully analyzing how aggressive policy moves could reshape global capital flows and weaken traditional confidence in the dollar. The dollar has long benefited from its role as the world's primary reserve currency, but that status depends heavily on stability and predictability. Trump's confrontational approach to trade has reignited fears of tariff wars that could disrupt global commerce and strain diplomatic relationships. Such trade conflicts often reduce international trust, prompting countries to reconsider their reliance on the US dollar for settlements. Market volatility has increased as traders react not only to economic data but also to political statements and sudden policy signals. Currency markets dislike uncertainty, and rapid shifts in tone from US leadership can amplify swings in the dollar's value. Fiscal policy is another major concern, as expectations of higher spending and tax changes could significantly expand the federal deficit. Rising deficits often raise alarms among foreign investors who finance US debt and help support dollar demand. If confidence in U.S. fiscal discipline weakens, investors may demand higher returns or shift toward alternative assets. Inflation fears have also returned, driven by the possibility that expansionary policies could push prices higher. Persistent inflation would complicate the Federal Reserve's task and potentially undermine faith in U.S. monetary management. Some analysts worry that political pressure on the central bank could threaten its independence over time. The perception of a less independent Federal Reserve could weaken the dollar's reputation as a stable store of value. Global central banks are watching closely, as changes in U.S. policy can influence their own reserve strategies. Several countries have already explored trade agreements that bypass the dollar to reduce exposure to U.S. political risk. This gradual move toward currency diversification reflects a broader reassessment of dollar dominance. Although de-dollarization remains limited, even small shifts can have meaningful long-term consequences. Geopolitical tensions further complicate the picture, adding another layer of risk to dollar-based systems. Sanctions and financial restrictions have encouraged some nations to seek alternatives to U.S.-controlled payment networks. Trump's policies have often emphasized national interest over global cooperation, unsettling long-standing alliances. Such shifts can weaken the soft power that has historically supported the dollar's global acceptance. The dollar's safe haven status is being tested as political unpredictability challenges traditional assumptions. In past crises, investors rushed toward the dollar, but current conditions suggest a more cautious response. Diversification into gold, other currencies, and digital assets has gained momentum amid ongoing uncertainty. Emerging markets are particularly vulnerable to dollar fluctuations driven by U.S. political developments. Sharp currency moves can trigger capital outflows and financial instability in developing economies. This interconnectedness means U.S. policy decisions now carry even greater global consequences. Corporate America is also affected, as multinational firms must manage currency risk tied to political headlines. Exchange rate volatility complicates investment planning and earnings forecasts for global businesses. Bond markets reflect these concerns, with yields responding to expectations of debt expansion and inflation. Foreign demand for U.S. Treasury securities remains strong but increasingly sensitive to confidence shifts. Any sustained decline in foreign appetite could put downward pressure on the dollar. Media coverage and market narratives have amplified fears, sometimes magnifying reactions beyond fundamentals. Still, many economists argue that the U.S. economy retains deep structural strengths. Large, liquid financial markets continue to make the dollar difficult to replace in the near term. No rival currency currently matches the scale, trust, and infrastructure supporting the dollar. However, history shows that reserve currency dominance can erode gradually rather than collapse suddenly. Long-term credibility depends on consistent policies and respect for global economic norms. Repeated shocks and confrontations can slowly weaken even the strongest financial foundations. Investors are increasingly focused on long-term risks rather than short-term political gains. Election cycles often bring volatility, but the current debate reflects deeper systemic concerns. Confidence, once shaken, can take years to fully recover in global finance. The dollar's future will depend on how policy decisions balance domestic priorities with global responsibility. Clear communication and predictable governance could help stabilize markets and restore trust. Without that clarity, uncertainty may continue to weigh on the dollar's global standing. Allies and rivals alike are reassessing their exposure to U.S. financial influence. This reassessment marks a critical moment in the evolving global currency landscape. Trump versus the dollar has become more than a political debate, shaping real financial outcomes. The outcome of this struggle will influence trade, investment, and power dynamics worldwide. Whether the dollar emerges stronger or weakened will depend on choices made in the coming years. For now, the world watches closely as America's currency faces one of its most complex tests yet.